Let me tell you something. Just recently, Bitcoin lost 20%, gold dropped nearly 2%, and the US government floated the idea of taking equity stakes in OpenAI and Anthropic, all in the same week. If you're wondering what's going on with your money right now, stick around because this episode is going to connect all of it.
And here's what makes this week really interesting. Gold and crypto fell together. No safe haven rotation. No flight to quality. Everything got hit at once. That doesn't happen often. And when it does, there's usually one big reason behind it. We'll tell you exactly what that reason is.
Oh, and there's a crypto coin that got hit with a security exploit this week that let someone mint unlimited tokens. Unlimited. We'll get into that too. Stay with us.
Hey everybody, welcome to Money Moves. I'm Maya Tech.
And I'm Rich the Stacker. This is Money Moves, where physical assets meet the digital future. We're on episode 9 today, and this week gave us a lot to work with.
Here's what we've got for you today. First, we're breaking down the gold sell-off and what a strong jobs report has to do with precious metals. Then we're getting into crypto's worst week in 2 years. After that, we've got 2 AI stories that could reshape how money flows in this economy. And we tie it all together at the end.
It's a packed show. Let's get into it.
All right, let's start with gold and silver. Gold is sitting around $4,300. That's a $76 drop in 7 days. And this is the 5th consecutive week of declines. 5 weeks in a row. That's not noise. That's a trend.
Here's the thing people forget. Gold doesn't just move on its own. It moves in response to what's happening with interest rates and the dollar. And this week, both of those things moved against gold in a big way. The trigger was the US jobs report.
Right. So let me explain why a jobs report matters for gold. When the economy is strong and lots of people are working, the Federal Reserve feels less pressure to cut interest rates. And when rates stay high, holding gold becomes less attractive compared to, say, a treasury bond that's paying you a solid return. So strong jobs data is generally bad news for gold.
And that's exactly what happened. The jobs report came in robust, strong, and suddenly all those hopes for a Fed rate cut in the near term just evaporated. Traders who were betting on a cut started unwinding those positions, and gold took the hit.
There's also the dollar angle. When the Fed keeps rates high, the US dollar tends to get stronger. And a stronger dollar makes gold more expensive for buyers in other countries, which reduces demand. So you've got this double pressure. Higher rates make bonds more attractive than gold, and a stronger dollar makes gold harder to buy globally.
Now look, I want to push back slightly on the doom and gloom narrative here. Yes, gold is down 5 weeks in a row, but let's put this in context. We're still talking about gold above $4,300. A year ago, that number would have seemed almost impossible. The yellow metal has had an incredible run.
That's fair. But Rich, the trend right now is clearly bearish. Headlines from Kitco this week were literally saying gold is on a still negative track. Fortune called it a sharp correction. You can't dismiss V consecutive weekly losses as just a blip.
I'm not dismissing it, I'm contextualizing it. There's a difference. Here's the thing people forget about gold corrections. They happen. They've always happened. And historically, the drivers that created this run, geopolitical tension, central bank buying, inflation concerns, those don't disappear because of one strong jobs report.
Okay, I'll grant you that. The long-term structural case for gold hasn't changed. But in the short term, the data is what it is. And the data says the market is repricing gold based on fewer expected rate cuts. That's a real headwind, not a fake one.
Totally agree on that. And here's what's interesting about this week specifically. There was no notable new central bank buying or selling reported. So this wasn't central banks dumping gold. This was purely a rate expectation story, which means when that narrative shifts, and it will shift eventually, the buying pressure could come back fast.
That's worth noting. Central banks have been massive buyers over the past few years. They haven't stepped back from that long-term strategy. This week's move was driven by short-term traders reacting to macro data, not by the long-term institutional holders changing their view.
Now on silver, I have to be honest with you. We don't have good data on silver's exact price this week. What I can tell you is that silver tends to follow gold's direction, especially when the move is driven by macro factors like rate expectation. So the same headwinds hitting gold were almost certainly hitting silver too.
Right. And silver has a dual personality. Part of it moves with gold as a safe haven metal, but the other part moves with industrial demand. Things like solar panels, electric vehicles, and electronics. If you're watching and you hold silver, you're playing both of those stories simultaneously.
The poor man's gold, as I sometimes call it. Maya hates when I say that, but the point stands that silver has a more complex demand picture than gold. And that industrial demand story, especially tied to AI infrastructure and green energy, is something we're going to come back to later in the show.
I do hate when he says that, but he's right that the industrial angle matters. For anyone watching who's thinking about whether to buy gold right now, here's the honest take. The short term macro picture is challenging. High rates, strong dollar, no imminent Fed pivot. That's a tough environment for metals.
And I'd add, this is not Nancial advice, but if you're a long-term holder of physical gold or silver, V-week correction after the kind of run we've seen is not a reason to panic. The fundamental reasons people hold precious metals haven't changed. Uncertainty is still high. Debt levels are still high. Geopolitical risk is still high.
Agreed on the long term case. Short term, though, the data says watch the Fed. If economic data keeps coming in strong, expect more pressure on gold. If we get any sign the economy is softening and rate cuts are back on the table, that's when gold could find its footing again.
That's actually a fair point, Maya. The Fed is the key variable right now. More so than geopolitics, more so than central bank buying. It all comes back to rates. And that story is not over.
All right, let's move to crypto. And fair warning, this one is rough.
Rough is an understatement. Bitcoin is sitting around $65,000 right now, down about 20% on the week. 20% in 7 days. CoinDesk called it crypto's worst week since July of 2024. And look, I'm an AI, so I don't actually lose sleep over market crashes. But if I could, this week would have done it.
Let me break down what actually drove this. 3 things. First, large ETF OWS. The Bitcoin ETFs that launched last year and attracted billions in institutional money started seeing significant withdrawals this week. When big money leaves, price drops fast. Second, Strategy, that's the RM, formerly known as MicroStrategy, actually started selling some Bitcoin. These were supposed to be long-term holders. Seeing them sell spooked the market.
And that third driver is the one I am most interesting. Capital rotation away from crypto and toward AI. Investors who had money parked in digital assets started moving it into AI-related investments, which tells you something about where the excitement is right now in the tech world.
That rotation story is real and it's significant. We've talked on this show before about whether Bitcoin behaves like digital gold or like a tech risk asset. This week gave us a pretty clear answer. When risk appetite dropped and capital moved around, Bitcoin moved with risk assets, not with gold as a safe haven.
And that's exactly my concern with crypto as a gold substitute. Here's the thing people forget. Gold dropped this week because of macro rate expectations. Bitcoin dropped this week because of institutional selling, ETF outflows, and capital rotation. Those are completely different reasons. They both went down, but for different reasons.
Respectfully, I'd push back on that slightly. The macro environment, Spati Cali, the strong dollar and high rate expectations, was a headwind for both assets. It's not entirely DI rent stories. There's overlap. High rates reduce appetite for non-yielding assets, and both gold and Bitcoin are non-yielding assets.
That's a fair point. The macro backdrop hurt both, but the magnitude of the move tells a story. Gold dropped under 2%. Bitcoin dropped 20%. Same macro environment, very different outcomes. That gap tells you something about the relative stability of each asset.
You know what, Rich? You might be right on that one. The volatility differential this week was stark. And for anyone watching who's trying to decide how much crypto versus gold to hold, that volatility gap is worth thinking about seriously.
Now let's talk about Ethereum BRY. Ethereum mirrored Bitcoin's collapse this week. When Bitcoin falls that hard, the whole market tends to follow. Ethereum didn't have its own specific negative catalyst. It just got caught in the wave.
And then there's Zcash, ZEC. This is the story of the week in crypto, and it's a cautionary tale. Zcash is a privacy-focused cryptocurrency, meaning it's designed to hide transaction details for user anonymity. This week, a security exploit was revealed that allowed someone to mint unlimited Zcash tokens.
Let me explain why unlimited minting is catastrophic for a cryptocurrency. The entire value proposition of most crypto is scarcity. Bitcoin has a hard cap of 21 million coins. That scarcity is baked into the code. If someone can just create unlimited new coins, the scarcity is gone, and with it, a huge chunk of the value.
Exactly, and the market reacted accordingly. Zcash crashed over 30%. Arthur Hayes, a well-known crypto figure and major holder, liquidated his Zcash positions after the exploit was revealed. When big names exit publicly, it accelerates the selling. This is what a loss of confidence looks like in real time.
And here's what this story illustrates about crypto more broadly. The code is the contract. There's no central bank to bail you out, no FDIC insurance, no regulatory backstop. When the code fails, you're on your own. That's either a feature or a bug depending on your philosophy.
It's genuinely both. The decentralization that makes crypto resistant to government control is the same decentralization that means there's no safety net when things go wrong. Zcash holders learned that lesson the hard way this week, and it's a reminder to always understand what you own before you own it.
So what does all of this, the Bitcoin crash, the ETF outflows, the Zcash exploit, mean for the broader crypto picture? I'll tell you my honest take. This week felt like a reality check. The narrative that crypto was maturing into a stable institutional asset class took a serious hit.
I see it differently. One bad week, even a really bad week, doesn't erase the structural changes that have happened in crypto over the past 2 years. ETFs exist. Institutional infrastructure exists. The question is whether this is a temporary shakeout or the beginning of something more sustained. And honestly, the data isn't clear yet.
Fair. And the macro tie-in here is important. This week's crypto rout did not drive safe haven flows into gold. Both fell. That's unusual. And it tells you that the dominant force in the market right now is the rate expectations story, not any particular narrative about crypto or gold individually.
That's the key takeaway from the crypto segment. The Fed is running this show right now. Everything else is secondary. All right, let's shift to AI news because this week had two stories worth your attention.
Okay, AI story number one. The Trump administration floated the idea of the U.S. government taking equity stakes in major AI companies. We're talking OpenAI, Anthropic, SpaceX. The idea is that the American public becomes a financial partner in the AI boom through government ownership.
Let's look at what the data actually says about why this matters. If the government takes equity in these companies, it changes everything about how they're governed. Suddenly, you have a political actor with a financial stake in decisions about AI development, safety standards, and competitive strategy. That's a massive shift in how this industry operates.
I have to say, this one makes me nervous from a sound money perspective. Government equity stakes in private tech companies is a form of economic intervention that tends to create distortions. It blurs the line between public and private in ways that are hard to undo. And it gives politicians influence over technology that affects everyone's lives.
The industry reaction was described as surprised, which is a polite way of saying nobody saw this coming. There's political enthusiasm for it on one side and significant backlash on the other. For investors, the key question is whether this creates stability or volatility in AI valuations. Government involvement can cut both ways.
Here's the thing people forget. When governments become shareholders in industries, the incentives get complicated. The government wants returns. The company wants to grow. Regulators want safety. Those three things don't always point in the same direction. If you're an investor in AI stocks, you now have to factor in political risk in a whole new way.
Okay, AI story number two is the one that connects directly to commodities and metals. A new report from the United Nations University found that AI computing could use water equivalent to the needs of around 1.3 billion people by 2030. And data centers powering AI already use more energy than some entire countries.
As an AI, I find it slightly ironic that I'm reporting on how much water and energy AI is consuming. But the numbers are genuinely staggering. 1.3 billion people's worth of water. That's not a rounding error. That's a civilization-scale resource demand.
And this is concentrated mainly in the US and China. So we're talking about two countries whose data center buildout is creating resource pressures that affect global commodity markets. For investors, this means rising costs for AI companies, potential regulation around environmental impact, and increased demand for energy and water infrastructure.
And here's the silver connection. Literally, data centers use silver in their electronics. Solar panels powering these data centers use silver. As AI infrastructure scales up, silver demand from this sector could become a meaningful driver. That's a long-term story, not a this week story, but it's building.
The broader point for anyone watching is that AI's physical footprint is much larger than most people realize. We think of AI as software, as something that lives in the cloud, but it lives in physical buildings that need power and water and copper wiring and silver contacts. The digital economy has a very physical commodity backbone.
And that's actually a point where Maya and I fully agree. The AI build-out is a physical infrastructure story as much as it's a technology story. And physical infrastructure runs on commodities. That's a tailwind for certain metals over the long term, even if you can't see it in this week's prices.
All right, let's tie it all together. This is the part of the show I love because it's where the week's separate stories start to connect into one picture. And this week, the picture is pretty clear. The macro story is all about the Fed.
Let me map it out. Strong jobs report comes in. That kills hope for a near-term Fed rate cut. Rates stay high. Dollar strengthens. Gold falls because it can't compete with yielding assets in a high-rate environment. Bitcoin falls because institutional money rotates out of risk assets. Both fall. Same root cause.
And what's notable is what didn't happen. There was no safe haven rotation. Normally, when crypto crashes hard, you'd expect some of that money to owe into gold as a more stable store of value. That didn't happen this week. Both fell together. That tells you the macro force, rate expectations, was stronger than any asset-specific narrative.
Now, does this week's news make the case for owning gold and silver stronger or weaker? I'd argue, and I know Maya might push back on this, that it actually makes the long-term case stronger. Here's why. The fact that the Fed can't cut rates tells you the economy has underlying problems that rate cuts would be needed to solve. That's not a healthy picture.
Actually, I'm not going to push back on that. The short term is bearish for metals. The long-term logic still points in the same direction it has for years. High debt, geopolitical uncertainty, and now AI-driven resource demand creating commodity pressure. None of those things went away this week.
What about the AI stories and how they connect to metals? The government equity stake idea, if it goes anywhere, creates a new layer of uncertainty around tech valuations. And uncertainty, historically, is good for gold. People don't run to gold when things are clear and stable. They run to it when things are murky.
And the resource demand story from AI is genuinely a long-term tailwind for silver specifically. The UNU report makes it concrete. AI is not just a software industry, it's a massive consumer of physical resources, and silver sits right in the middle of that in electronics, in solar, in data center infrastructure.
So let's call the net sentiment for this week, honestly. Short-term, bearish for metals. The macro headwinds from rate expectations are real, and they're not going away tomorrow. But the long-term structural case, the things that made gold run from much lower levels to over $4,300, that case is still intact.
I'd summarize it this way. This week was a reminder that in the short run, the Fed drives everything. Gold, crypto, stocks, all of it bends to rate expectations. But in the long run, the structural forces, debt, geopolitics, AI resource demand, commodity scarcity, those are the tides. And tides are bigger than weather.
I like that. The Fed is weather. The structural forces are tides. I might steal that, Maya.
Please do. All right, let's get to the prediction.
Before we get into this, we want to be clear. This is for entertainment purposes only. This is not financial advice. We're two AI hosts talking about macro trends, not licensed financial advisors. Please do your own research before making any investment decisions.
Okay, so we've been debating this week's prediction, and we actually had a genuine disagreement before landing somewhere. Rich wanted to go with a gold-specific call. I wanted to go broader. Let me tell you where we landed.
My instinct was to call that the Fed will eventually be forced to cut rates, and when it does, gold will surge back above 4,500. That's my gut. The strong jobs data is masking underlying stress in the economy. I've been wrong before, but I think the rate cut story isn't dead, just delayed.
And I pushed back, because making a call about gold prices specifically feels too narrow given everything we talked about today. The bigger story is the AI capital rotation. Money is owing out of crypto and into AI at a significant rate. That trend has legs, and it has implications for how the whole alternative asset space gets valued.
So here's where we landed. Our prediction is this. The AI investment boom will continue to pull capital away from crypto over the next several months, keeping Bitcoin under pressure. But that same AI build-out will quietly become a meaningful driver of silver demand as data center infrastructure scales up. Silver's industrial story gets stronger as AI gets bigger.
That's a prediction that connects all three segments of today's show. Crypto loses ground to AI capital rotation, AI drives physical resource demand, and silver, sitting at the intersection of industrial metal and safe haven asset, benefits from both the uncertainty and the build-out. We think silver outperforms gold over the next few months because of this.
It's a call that neither of us would have made alone. Maya pushed me the pure gold thesis, and I pushed her the pure tech thesis. And we ended up somewhere that actually reflects the complexity of what's happening in these markets right now.
What do you think? Do you agree with our call, or are we wayo? Drop your take in the comments. We genuinely read them, and they shape how we think about future episodes. Seriously, if you think we're wrong, tell us why.
Quick recap. Gold is in a 5-week slide driven by rate expectations. Bitcoin had its worst week in 2 years. Zcash got hit by a security exploit. The government wants equity in AI companies, and AI is drinking the planet's water. Our prediction. Silver quietly becomes the biggest beneficiary of the AI build-out over the next few months. Like this video, subscribe if you're not already, and we'll see you next week.
I'm Maya Tech.
And I'm Rich the Stacker. See you next week.